Hello, everybody, and welcome back to the Bull Moose Podcast. I'm Ryan Walsh, and I'm joined with my partners Mike Bark, Andrew Witt today, and our producer Thomas Still. In the last few episodes, we discussed why you might need a CPA and the overall practice of buying a dental practice. And today we thought it would be a good idea to get into the business valuation topic and discuss the various approaches that you would take to evaluation, as well as some of the common mistakes that you might encounter during the process. Today we have my partner, as I mentioned, Mike Bark, who's a CPA and a certified valuations analyst, here to discuss these topics in depth with you. Mike, what type of approaches do you mostly see when you're doing evaluation for our clients?
So there's three basic approaches you can do for evaluation, and as a certified valuation analyst, we're supposed to consider all three, especially if we're doing what's called an opinion of value. And an opinion of value is something that's needed if you're doing litigation, if you are doing estate and gift planning support, and to kind of check the IRS's boxes. But those three approaches are an asset-based approach, a market-based approach, and an income approach. And to kind of briefly walk you through the two that we don't use very often, what an asset approach is what you might consider to be a liquidation value of a company. So for example, if we were to sell Bull Moose Financial, how much are our assets worth? I mean, we have some computers, we have some podcasting equipment, we have computer screens. And in short, the answer, our asset value isn't worth all that much. Our ability and the ability of our clients to have some value is a sort of intangible element of goodwill, or this ability to earn a living by having an existing customer base. So an asset approach is almost certainly going to understate value of a dental practice. So we don't consider it very often. It would only be like in a liquidation type circumstance. The second approach would be a market-based approach. And when you think of market-based approach, I would think of if you wanted to buy some Apple stock right now, you would go online and they would tell you exactly what Apple's worth. You could buy a share for whatever it happens to be trading at today. That's a ready market. There's a bunch of data that goes behind it. The price is there. Well, with a dental practice, it's a little bit trickier. There's some published data that is out there. So for example, we know most practices will sell somewhere between 55% of their collections up to 120% of their collections. But what determines whether or not somebody's 55% or 120? It's a good sanity check approach, and we do use that in our valuations, where we know the average practice will sell at about 80% of collections. So if we value a practice and that ratio ends up higher than that, we should know that it's an above average practice or be able to justify that. And then finally, we have an income-based approach, and that's the one we primarily use. The reason we use it is that's what the banks use for lending purposes. That is what a DSO is going to look at when they are trying to figure out how much your practice is worth. What an income approach is it tries to figure out how much money an owner makes after all expenses are paid in a practice, and then they apply a multiple to it. Or if you think of a multiple, it's kind of an inverse of a capitalization rate, where it's a rate of return. And most dental practices will sell somewhere between a 4 to 7 multiple of these earnings. In terms of doing the income approach, for us, there's a couple things that we have to do. The first thing is, what we're trying to do is determine what does the future revenues of the practice look like. And the best way to determine what the future looks like is to look at the past. So first thing we always gather up is the past 3 to 5 years of financial statements, tax returns, and production by provider reports of a dental practice. And we'll spread all that data out. And our first step is to do what we call normalize, or make adjustments to the income on there. So you get this financial statement out there and it says Dr. X made so much money. Well, why do we have to normalize it from that point on? And there's some common adjustments that we have to make as valuators when we look at a dental practice. The biggest one, and I think the one you should see in any valuation report, is an adjustment to the doctor's wages. And the reason for that is depending on how that doctor is taxed, will largely dictate how they pay themselves a salary. So, for example, if they are a sole proprietor for tax purposes, they don't even draw a W 2 salary for their services. If they are an S corporation, there's a tax motivation to pay themselves a below market rate of salary so they can save on things like self employment taxes. Conversely, if they're doing a full profit sharing plan in their particular practice, they might be paying themselves a W 2 salary of $350,000 so they can maximize that, but their true salary really isn't $350,000. So, how we adjust that is we look at those production by provider reports and we'll take a look at how much is a doctor producing and then look at that number and go, well, we know most associates will earn 30% of their collections. So we'll look at the doctor's production, multiply that by 30. In some cases, we may go as high as 35%, depending on the market, but that's how we'll normalize that particular one. I think the second thing, if it exists within a practice, that usually should be added back, and it could be a positive or a negative adjustment, is with family wages. As you know, Ryan, I mean, there's all sorts of kids who are on the payroll, quote unquote, cleaning the office or modeling for the particular practice. Well, those aren't people that you would normally hire within a dental practice. They are on there simply to shift income from a high tax bracket down into a lower tax bracket. So in those cases, those wages should be added back to the income stream of a dental practice. Sometimes you also see a spouse on the payroll. And sometimes the spouse has an active role. I mean, we see spouses as office managers all the time. And sometimes they're actually being paid a below market rate because that dentist does not want to pay extra FICA taxes on wages. So they may pay just enough so that they maximize the 401k and that's it. Or they might just be on the payroll and have no idea where the dental office is and be drawing a salary just simply to double up the 401k contribution. So you have to look at family wages. Are they ordinary and necessary to the operation of the business, and adjust those to market value? Another thing I would look at is if a practice has excess retirement contributions. And what I mean by that is a dental practice that might be doing full-blown profit sharing contributions, where that dentist is trying to put away $70,000 plus into a retirement plan because they might be behind on retirement. The demographics may favor them. We will usually normalize that back to what a 401k would typically do, which is 3 to 4% of a staff person's wages versus 12 to 13%. I think you should see adjustments if it's owner occupied. If the dentist owns their own building, there's a tax incentive to pay yourself excess rent on, from your practice, because there's a qualified business income tax deduction and all those things. So you'll want to bring the rent back to fair market value. If they're leasing from a third party, well, the rent is what the rent happens to be. I mean, there's no games going into that, but if it's owner occupied, you should see an adjustment there. I think every valuator should take a look at depreciation adjustments. The reason being is a lot of times we'll see valuators just simply add back depreciation, but the reality is, in our opinion, depreciation should be adjusted to a ordinary amount for a year. And the reason we have to do this is, if you're running a dental practice, you're not going to simply buy the same amount of equipment every year. You're going to have some years where you buy a ton of equipment, and then you could go 3 or 4 years where you're barely buying anything at all. And how we make that adjustment is we take a look at your asset base, so we'll go to your balance sheet and go, well, how much dental equipment do you own? And then we will adjust that depending on the type of dentist you are, we'll go somewhere between 15 to 20 years and say on average your equipment will have a useful life of 15 to 20 years. So we would expect you to spend X number of dollars every particular year. Amortization expense, it's just a deduction you get if when you buy a practice, you get to write off the goodwill that you purchased over 15 years. There's no money that changes hands with that, so we add that back to the income stream. Same thing with interest expense. If a doctor has practice debt, the expectation is when they sell their practice, they are going to retire that debt and they're going to pay that off. So interest expense gets added back to the income stream. And then I think finally we're looking for any truly tax motivated type things. The doctor who may be a little generous with their Costco runs or meals and entertainment or continuing education always tends to be in really nice places like Hawaii versus doing it online, or any what we would call non-recurring expenses. So you could have a consultant who comes in one year, that's a big ticket item, and then you never really use that consultant again. Or you could be bringing in an associate in your practice. They have higher than usual legal bills that year because they have to do all those contracts. It's a non-recurring type expense. Big thing on any income adjustment, though, in our opinion, is should be very easy for a layperson to understand why that adjustment is being made. And in fact, in our reports, there'll be a section that explains each adjustment, why we're making that adjustment, and it should be a detailed analysis of why that adjustment's being made, not just simply we needed to get to a number, so here's the adjustment that we made.
Right. Yeah, I think that's that's very important. I think you got to nail down the financials and make sure that you get a true profit of the business, in order to present a accurate valuation for the buyer or the seller. So you mentioned that the income approach is the most common that you see. Do you see any mistakes when you're looking at other people's valuation reports or anything like that?
I think the biggest one we see is you'll see adjustments, and the adjustment simply says something to the effect of, most common one is, let's just say that dental office has relatively high staff expenses. And we know from doing our clients, on average, clients are usually around 28%. Well, let's just say, your target practice is at 33 or 34%. And you'll see an adjustment in there to go, hey, we brought staff wages back to 25% because that's a historical norm within dental. And you look at an adjustment like that and you go, well, if I'm buying a practice, is the first thing I'm going to do to be able to go in there and say, hey, good news, bad news, guys. Good news is you still have a job. The bad news is this valuation report says you're being paid too much. So we're going to adjust a bunch of your wages down so we can get to 25%. That's not reality. I mean, it's a great way to impair your goodwill. Now, you could have a situation where a dental practice, they might be hanging on to an employee who's very close to retirement, who's going to walk out the door the minute that dentist retires. Okay, that's a legitimate thing right there. We also see, like in dental supplies, you'll come across a practice between supplies and lab that's running a little bit higher than usual. And we know, again, from our practices, dental supplies and lab as a total will run somewhere between 10 and 13% of the collections. And this particular target practice is high, and they'll go, well, we just brought it down to 10% because. Well, it could be a dental practice where there's more doctor production than hygiene production. It could be a practice that's doing things like Invisalign, or they're doing a lot of implants, or they're doing things where they're organically going to have a higher than average cost. None of the adjustments that are in there should be something that goes, well, I adjusted it to this number just to satisfy the industry thing. We see it all the time in advertising is another one where if a practice is historically spent a little higher than average, I look at that and say, well, that practice maybe needed to spend a little higher than average. It might be more fee for service. They might have a few things going on that necessitate that. So you can't just simply go, hey, we're adjusting things down to what we think an industry norm might be to get to a number. And I think especially with like staff wages is a big one, because that's just a cost that I think we talked about it a little bit in the other podcast. When you're looking to buy a practice, something that's got really high staff costs and really high occupancy expense, that's not something we can fix right away as new owners. So having an adjustment that just simply brings it down, to me, doesn't make sense unless there's a real rational reason behind it.
Right. I mean, just because it's the industry standard doesn't necessarily mean that that's what that office should be running at. I mean, and typically the historical financial statements will reflect that, right? Especially with like non-family wages, right? I mean,
Well,
yeah,
you look at it, you think of most practices that are selling, they're usually a doctor that is close to retirement age themselves. I mean, we have seen a rise of younger dentists who are looking to sell to DSOs and become part of that. But you look at some older practices, they tend to run slightly higher than normal wages simply because their staff tends to be more tenured. They've been there a little bit longer. And, quite frankly, you can spend a little too much on staff in the big picture and have savings in other areas. I have found there tends to be a relationship between our dental offices that spend maybe a little more on staff, but they run way more efficiently on their supply and lab ordering, or they're more productive, or there's things in there that kind of counter that particular spending. So trying to bring everything back to an industry norm, I'm not saying it's not possible to bring things back to an industry norm, but if I'm the buyer, I have to be the one who goes and implements those changes to make it happen. I have to do something proactive to do it. I can come in as a new owner and say, well, we have too many staff people. I'm going to get rid of 3 people. And maybe it works out for you, but chances are, it doesn't.
right. You'd have to, obviously you'd have to go out and hire new people, right? Which is difficult. And then, the new hires could potentially not, perform to the level that the previous staff performed at. That could have a negative impact on the overall practice itself, right?
Well, and I think most consultants will tell you when you go in and you buy a practice, yes, changes are going to occur. You're going to naturally gravitate toward the way you want to practice. You're the owner of the practice, but you're not going to come in there like a battering ram and do everything all at once. Chances are there's things you're going to implement over 1, 2, 3 years that's going to take some time to do. And we've seen clients who've gone in and been the battering ram, and then you see them in year 2 or year 3, and you're seeing that dental practice going kind of the wrong way because they are turning over staff. They are, if you're a patient and you keep coming in and you're seeing different people, that word gets out, pretty quickly. These are all, even if you're in a big city, these are all small businesses. And I think one of the reasons we all come to a private dentist or a smaller CPA firm is this comfort level. It's going to be the same people. So again, it doesn't mean staff's not going to turn over. You're not going to make some changes, but if costs like that are a little bit high, they're going to be difficult to undo immediately.
Right.
You can always, if you look at the way a DSO is going to look at a practice, yes, internally they're going to look at it and go, well, if you're high on supplies and stuff because you're doing this, this, and this, well, DSO has the buying power. They have the purchasing power. They can come in and unilaterally go, okay, you're using these vendors. We have these price discounts. And as they do an internal valuation, they may look at some numbers more favorably. But as a private buyer, there's a lot of changes you're going to have to make organically to lower those numbers, from your production mix potentially to what vendors you're used to using and all those kind of things.
Right. Yeah. So like you kind of mentioned, it's, there should be a valid reason for all of these adjustments that occur with the valuation report.
Yeah, I think again, I guess the reasoning I use when I do a valuation report is if I write it up and I hand it to my wife. And my wife's great. She's a librarian. She has a master's degree, very smart, very well read, but not a finance person. Can she read it and understand why those adjustments are being made? And if she can, then I think we've done our job as evaluators to be able to defend any adjustment that we made. And that, again, somebody who's using the report, I mean, you see a lot of these reports and there's a bunch of numbers and there's a bunch of graphs, but there's never a clear through line on how they ended up getting to the actual value. And as somebody who's reviewing a valuation, it's frustrating even for us where we look at it and go, well, if you gave me a clear through line, I could at least agree or disagree with your conclusion. And now I have to go and kind of redo quite a bit of your work to try to determine what we think the value is. So I think that narrative needs to be clear, concise, and a simple through line that somebody can go, well, why didn't you use the market approach? And we explain very clearly why we don't use it. Or why didn't you use the asset approach? And it's explained, why did you make these adjustments? And try to tie all those things together so somebody can go from start to finish and know what the value is. And again, they can disagree with us at the end of it, but they'll know why they're disagreeing.
Right. Do you receive a lot of pushbacks on most of your adjustments, or do you mostly you know explain them well enough that you don't encounter a lot of pushback?
Not really on the adjustment. We always get a little bit of pushback either on multiple, which we'll probably talk about a little bit later, what the multiple should be. And I think every dentist, if we're doing that, they're nearing retirement and we're doing that valuation of their practice, they're probably always hoping for a higher number than what we came up with. And you try to explain to them, when we do a valuation, we're trying to determine the likeliest sales price for your particular practice. So it's hard to weigh in. Well, yes, you could get a DSO to come in and potentially overpay you, but it comes with these strings attached. You're going to have to continue to work. You might be taking a holdback in some of the revenue. You might have to guarantee certain performances. So we're trying to figure out the likeliest price. And any of our clients or anybody who runs a business, you have your identities wrapped up in that to some extent. You've put a lot of work into it. You've established a lot of systems and procedures. So we all think our business is probably worth more than it is. I mean, it's not exclusive
Right.
to dentistry. I think we would probably be disappointed in the valuation of our firm, maybe.
Right.
But
Yeah. Well, I guess it
But-
depends on what side of the transaction you sit on, right?
Exactly. I mean, most sellers tend to be a little disappointed by it. I think most buyers, for the most part, I mean, dentistry's been on such a bull run for a long time in terms of practice values have stayed relatively high. One of the old metrics out there were dental practices sold for about 60% of their collections. And realistically, I mean, you still see some down around that level, especially if they have high overhead. But, you see, again, the average is somewhere around 80%, and you see some selling, if they're a big enough practice, they have multiple doctors, could go for 120 to 130% of collections. So they've been on a bull run, so I think sellers get it. But, yeah, in terms of the actual adjustments we're making, we rarely get any pushback. I mean, I think I try to do a report with as few adjustments as I possibly can. And you see some reports will have 19 or 20 adjustments. And if I'm sitting on that other side, all I have to do is punch a hole into one. And if I can punch a hole into one, well, now
Right.
we're doubting the whole report.
Right. Exactly. Well, yeah, you've mentioned in the past on this episode the multiplier, and I think that's a pretty important aspect of the valuation. Once you determine, once you get a clean net income after the adjustments that you make, obviously, then you determine what multiplier to use in order to value the business. Why don't you talk a little bit about that and what you typically see with these dental practices?
So in the valuation world, we actually use a concept called capitalization rate. And what a capitalization rate is a rate of return that an investor would expect to get based on the risks associated with an investment. And how we generally determine it, when we're doing nerdy valuations in other industries is what's called a build-up method, where we look at, well, the safest thing you could do is a 20-year bond, and that's right now paying out at 4%, and they add specific risk factors to it. In dentistry, people tend to talk in terms of multiples, and what a multiple really is the inverse of a capitalization rate. So, for example, a multiple of 4 translates to a 25% rate of return. 5 is a 20, so on and so forth. What we see is most dental practices sell between a multiple of 4 and as high as 7. Now, of course, if you're part of a group practice and you have multiple locations, you can, I think, get to 9 or 10. There's all the old tales out there. Heartland Dental at one point sold for a 13 to 14x multiple, but I think they had 300 practices at that particular time to a private equity. But most private dental practices will be between 4 and 7. And I think what drives that is a number of factors. To me, the biggest one is probably still location. If you are in an urban or suburban environment, there's just a bigger group of buyers out there for you. We've talked before, and we've talked with clients. If you wanted the most profitable, safe dental practice, if you're willing to live in a rural area, that's where you want to be. But the reality is there's not as many people who want to buy there as they want to buy in Milwaukee. So a practice that's located in a Milwaukee suburb will probably sell for one, that's located in like a Port Washington, just to use a Wisconsin example. I think the second factor is size of the practice. And the reason for that is, if you can get your practice, I would say, to $1.2 million of collections or north, it opens up the number of buyers, because not only are private buyers interested in that size of a practice, but that's kind of where you get the DSO starting to look at. Most DSOs, unless it's a very strategic acquisition, do not want a practice that's collecting $500,000 a year. They want $1.2 million or north, or sometimes even higher than that. So the size of the practice has some bearing on it. I think if you're a multi-doctor practice, that helps get you closer to the 7. The reason being is, to think of it, if you think of a single owner dental practice, if that dentist gets hit by a truck tomorrow, we have a big problem. We have to replace that production right away. And even if you're in an urban environment where you can hire an associate relatively easy, you're going to have a disruption of services, that trust level in that doctor, that importance of when a doctor sells their practice, endorsing the next doctor is really important. In a multi-doctor practice, where you have 7 or 8 providers, that doesn't matter as much. They're going to sell for a higher multiple. People expect dentists are going to get older, they're going to retire and stuff like that. So again, I'm glad in our business I have partners, because if something happens to me, things carry on. We can still get tax returns out. We can still get financial statements out. A big driver of it, and probably unfortunately not quite as big as those first 3 things I talked about, is the profitability of a practice. I was just doing one where they had really high occupancy expense and very high labor, and they ended up at a low valuation because the cash flow is just not there. But profitability is a big one. And if you can kind of unlock, I would say, staff wages at a reasonable percentage, occupancy expenses at a reasonable position, and you're profitable, that's going to help. Again, if you're in a rural area, it's not going to help maybe as much as it should, but profitability is a big one. Especially within the areas of occupancy and staff wages. And I think one of the final things is the state of the equipment, the curb appeal of the practice. I think a practice that's in a standalone building intrinsically has a little more value. It's kind of built in advertising. If it doesn't look like a museum when you walk into that dental practice, I don't know if anybody's old enough to remember the old things that we had to spit in back in the old days. And they're using all paper charts, and they're using all the small bite wing technology. That it's not a as big of a factor as one would think. But if a place looks turnkey, somebody's going to be willing to overpay a little bit. They're not going to mind. They're not going to push back on price as hard if everything looks good. Everything's got a fresh coat of paint on it. The floors aren't shag carpeted and those kind of things. It's just like when you're buying a home. I mean, if something's turnkey, you might dig a little bit deeper if it's a turnkey thing versus, we're going to have to do a lot of work on this house to get it to where we need it to go. So I think those are the biggest determinants. I'd say most private practices are between that 4 and 7, and probably on average practice is going to be somewhere right around 5 on it. If you're a 6 or a 7, you're going to have some factors going for it, like bigger size, good profitability, good location, and all those things to drive that value up. And then I think as you look at like DSOs and things like that, yes, sometimes they will go above that 7, but I think a 4 to 7 is what you would expect, and that's ultimately going to translate on average. If you get a 5 multiple, where that market approach comes in, is that usually is going to translate for most practices to about 75 to 80% of collections. It's just kind of how the math works.
Great. Yeah. So, I mean, this is probably a pretty basic question, but the multiplier, is that multiplied by the net income of the practice, or is that multiplied by the net income plus all of the officer compensation?
So it's that normalized net income. So we go through, we restate the financial statements. Generally speaking, we want to see an average or a weighted average of the past 3 years. We'll use a weighted average if we see some trend lines in a dental practice. So for example, practices steadily increasing their profitability or conversely decreasing their profitability, we'll probably use a weighted average. If they're somewhat static, we'll just use an average of 3 years and go, well, again, we're trying to determine the future, and the best way to determine the future is to figure out what happened in the past. That whoever takes over the dental practice is going to continue on, with that particular practice. Maybe they're going to have the ability to build some things into it and do some things to make it better and more profitable, and that's on them at that point.
Right. Well, great. Thanks, Mike. I think this is a very important topic to discuss, and I'm glad you were able to take the time to do that today. We welcome any of you to reach out to us if you have any further questions. You can find us at bullmoosefinancial.com, and we'd be happy to further the discussion with you if you have any questions or anything like that. Until next time, this is
Ryan, if I could give a quick plug for our next episode.
Yeah, please do.
We're going to have Sean Epp on. Sean, he's been in the dental industry for as long as I can remember him being in it. Previously worked at Midwest Dental, which was a massive DSO in the state of Wisconsin. He's currently a practice broker, so he's been on both sides of this valuation game. So he'll be on next week talking a little bit about DSOs, the state of dental valuations, and adding some insight from somebody who's worked both sides. So we're excited to have him on next week.
Yeah, great. Yeah, looking forward to that one. That should be.
That's why you gotta smash the subscribe button.
Yeah, please subscribe, like,
tell your family and friends.
Do all that stuff. Tell everybody
Thomas got us a great new podcast logo.
Yep.
We might put that on like some coffee mugs or something. That if you subscribe, maybe we send you a mug.
Yeah, can never have too many mugs, right?
Can never have too many mugs for the trade shows. So.
All right. Well, we look forward to that next episode, and until next time, this is the Bull Moose Podcast. I'm Ryan Walsh for Mike Bark, Andrew Witt, and producer Thomas Stilt. We'll talk to you next time.